Hey everyone, me Kevin here. In this video, I'm going to talk about what Cathie Wood just said, but I'm also going to provide you my opinion layered into a summary of what Cathie Wood just said in her latest release on the Archegos channel. Cathie Wood is a bit surprised about the Federal Reserve, and this is where we're going to start. First, she wonders why Jerome Powell is now focused on things like homelessness, when she believes that Jerome Powell should be focused on inflation, jobs, and growth in the economy. She says she's not saying that preventing homelessness is bad, but she's worried that Jerome Powell is diversifying with his mission and his focus too much. My opinion on this? Well, she's right. This is something we've talked about on the channel before over the last few weeks, and I mentioned too, I thought it was kind of different. It was a shift in Jerome Powell's stance is what I talked about it as, and the shift was all of a sudden Jerome Powell is talking about a lot of social goods like climate change or homelessness. And it's definitely a shift when the Federal Reserve has usually only been focused on jobs and growth. Another shift is the Federal Reserve focusing heavily on max unemployment or max employment and defining that as making sure that blacks and Hispanics, minorities, women all get back to full employment. So sort of broadening the mission of the Fed. In my opinion, this broadening of the Fed is actually a way of the Fed saying, look, we'll keep rates low longer because we want all of these things to do well. Well, those aren't going to be the first things that are going to do better. Whites and Asians have a much lower unemployment rate than blacks and women. So even when the total unemployment rate goes down to 3.5%, 4% again, it might be a while for minorities and women to get their unemployment rate down. And so this to me is a tell that the Fed might try to keep rates lower longer, unless of course they get squeezed down by inflation, which Cathie's going to be talking about in just a moment. Cathie also says that here's the thing. Jerome Powell should be focused on inflation and growth, but this was a big one. She says she's worried that the Fed is potentially losing control. She says, quote, "I'm not sure inflation is in the Fed's control." This is a big statement here. This is really Cathie saying, hey, look, maybe they're spreading their mission out because they realize they're losing control on inflation. It's maybe a little bit jaded, but she could be right, and she's echoing a symptom, or I should say a sentiment, of what a lot of folks believe about inflation. That basically, the Fed's getting ready to get smacked upside the head, and the Fed's going to realize they're going to have to raise rates. Remember what Jerome Powell just said at the IMF, at the International Monetary Fund, when Sarah Eisen from CNBC asked, what are you going to do if you start losing control of inflation? Are you going to raise rates? Jerome Powell said, well, yes, that would be the principal tool that we would use to control inflation. So Cathie could be right here. And a lot of people believe that big inflation is coming and the Fed's losing control. Cathie used the PPI increase, the Producer Price Index, a measure of inflation increase, as a way to sort of evidence that this inflation is starting to manifest itself in actual readings. On Tuesday, we get CPI data, and we're expecting to get smacked in the face with some ugly year-over-year CPI data. But what we're really going to pay attention to is that month-over-month data. The PPI month-over-month data came in at a 1% inflation rate, which if you analyze that, that's over 12%. It's 12%. That's huge. That's a lot. That's a big inflation rate. Cathie says she believes that Jerome won't react to this, which is something that he said, and is happy that the market has been mostly muted in reaction to this, and that's potentially because the market has already heavily priced in inflation in that crash that we've kind of seen in the higher multiple stocks between February 19th and March. And this is something that I agree with Cathie on as well. Remember that car analogy we've made on this channel where essentially, oh my gosh, higher inflation's coming. All of a sudden bond yields rise quickly and it's kind of like, whoa, you're in a car and all of a sudden it jerks really fast rather than a nice smooth acceleration. She's right. We're getting a lot of jerkiness in this data, and the market is not overall really liking it. This is leading to what feels like a very bizarre market. Hard to kind of grasp exactly the direction the market's going to go in the short term. In the long run, we know that Cathie and even myself are really bullish on high innovation style stocks. We'll see. Anyway, Cathie Wood goes on to talk about the fiscal governance in our country. She talks about us spending money like essentially there's no tomorrow. She talks about how there is currently a 63% increase in federal outlays, massive increases in the deficit, $4 trillion a year being spent, and Biden now wanting to add another $2.2 trillion infrastructure plan. Cathie says this is going to lead to the market to be essentially in a, quote, confusing period as the market tries to sort this all out. And this echoes what we felt over the last 6 weeks. We felt that sudden jolt in the bond market, which hit the stock market hard. Now lately, we're kind of like, okay, all right, what's going on? Which way are we going? Even recovery stocks and some of the value stocks have sold off a little bit. Now we're like, okay, all right, where are we going now? Right? Cathie says the reason for this is maybe in addition to the rate shock we have, the fact that because every day it's like, oh, here's another thing. We're going to be spending more money and more money and more money. At least the way it feels in the media, it feels that way, that every day we're always talking about spending more and more money. She worries, look, the market is going to be confused by this. And she calls this a confusing period that we're going in. And in her interview, or in her discussion, I should say, she sort of mentions that this could take 6+ months to sort out. So we could be in this weird period for quite some time to come. I thought that was interesting to highlight that potentially this confusing period might not just be a 6-week issue, but it could be something as long as 6 months. So we'll see. Furthermore, on taxes, so on the corporate tax rate, Cathie Wood believes that rates for corporations won't end up going up to 28%, that they'll end up getting negotiated down to about 25%. My opinion on this is she's probably right on this again, and I agree with Cathie on a lot of things. I'll let you know when I really clearly disagree with her, which I will in this video as well. But she mentions that she believes this rate's going to get negotiated down to 25%. I believe this is very possible because of people like Joe Manchin. Joe Manchin, remember what Joe Manchin did with the stimulus checks last time? Joe Biden said, hey, you know what? Maybe we'll be open to negotiating the flexibility of who gets the stimulus check. Right before the stimulus package passes, Joe Manchin says, I want less people to be eligible for the check. Otherwise, I'm not voting for it. He's that 50th vote in the Senate. They need him as a Democrat. He ends up getting what he wants. And stimulus checks end up getting reduced for qualifications for families by, from up to $200,000 to get a check, scroll down to $160,000, and up to $100,000 as an individual, scroll down to $80,000 as a cap for getting a stimulus check. Joe Manchin won there. I expect the same thing potentially to happen with the corporate tax rate. We already know that Joe Manchin is opposed to the 28% tax rate, so just stay tuned. I would not be surprised if he ends up putting up a wall, drawing a line in the sand and saying, I will not vote for this unless that corporate tax rate is lower. I'm okay with it going up, but not that much. And guess what Joe Biden's already said? He's open to negotiating the corporate tax rate. That was a big bomb that dropped last week. So right here, Cathie's suspicion is probably going to be correct. And I'm kind of outlining some of the mechanics as to how that could happen. On a personal tax rate, Cathie Wood suggested potentially ARK Invest might be leaving New York. New York is increasing state income taxes. She sees an exodus from New York and Connecticut, even California, and she sees this trend accelerating as businesses and people consider leaving to states like Florida. This was a big statement. Now we'll see. I can't convince Lauren to leave California, so at least for the time being, I won't be part of that exodus, but I totally get it. Trust me, I do the numbers all the time. Now, on the economy, Cathie Wood says that the economy is rebounding nicely from the weather hit that we sort of had in January and February. And she mentions that we have not seen economic data as strong as we're seeing it now since 1994. She also mentions that the latest unemployment report came in stronger, that the average work week went up 0.2 hours, which is larger than expected. And this is potentially a sign that companies are struggling to keep up with demand, labor shortages, job openings at record highs. And she sort of outlines why she thinks we're going into this booming recovery. My opinion on this, I have to agree again. The fact that right now, companies are struggling to keep up not only with supply chain disruptions, but hiring folks because companies are still competing. Even though, there's research that says maybe companies aren't, the fact of the matter is, there is still an unemployment boost of $300 per week. We're not going to see that unemployment boost go away until September. And so it's entirely possible that in the lower wage tier segment, we might see less competitiveness for job openings, leading to more job openness In other words, less people are looking for those jobs, right? And so businesses are spending more of an effort trying to find people to get their businesses back up and running. And this is also accelerated by the fact that less people are traveling to the United States to do temporary work. Like we have the J1 visas, and these are folks who come to America for a season, like at ski resorts and work at restaurants or whatever. And we're seeing less of those now because of the disproportionate impact COVID is having around the world. So that's also accelerating this trend that Cathie's talking about. Commodity prices she sees soaring. She kind of just mentioned that. Obviously, we know a lot of this has to do with huge supply chain issues right now. So adding my comment on that. She does mention, though, that the dollar is going up, which is something big that nobody really expected to be happening, or that it would happen. And she says that a strong dollar could help counter higher inflation as long as we have strong productivity. So she kind of sees a little bit of a dueling match here. Can we get to strong productivity while having a stronger dollar? Remember, if we have a strong dollar, it's harder for us to export our goods. So that means we maybe are able to sell less goods abroad. So this is sort of that dueling match that she sees here. But she's right. Nobody did expect the dollar to go up. A lot of folks were thinking the dollar was going to continue its crash, and it was slipping down substantially. So the fact that it's going up now is bizarre. She's correct about this again. Then she brings up her inflation argument again, which I've broken down quite a few times. I'm not going to rehash it in full here. Basically, good deflation is technological innovation. Bad deflation is when old guard companies have to drop their prices to compete. She sees all of these things, a strong dollar, hyper productivity in the economy, and these two deflationary forces as keeping prices down. However, she is concerned that the Fed is going to lose control of inflation and that there will have to be an interest rate increase. Now, she's not proposing hyperinflation, but even if inflation sits around 3 or 4%, the Fed's going to have to raise rates sooner to control that and bring that back down to that 2% range. Now, Cathie provides a reason as to why potentially we saw a massive jolt in bond yields in March and February. She believes that banks started to realize that, we're not going to get the SLR, the liquidity ratios extended with the Fed, so banks are going to have more liquidity. And so as banks came to realize that, banks potentially sold bonds, which if you sell bonds, price goes down, yield goes up. But what's the other benefit of selling bonds? You have cash. If you have more cash, you qualify towards these ratios more. So potentially, banks were big sellers of bonds, she believes, and that's why we saw this jolt in yields, and maybe we might see a pause. Maybe that's why things have settled down, because that target date was March 31st. Maybe that's why we'll see this relaxed, sort of potentially slow but still confused recovery here in April. Another thing she mentions, which, and I swear I'm gonna disagree with Cathie here in a moment, okay? There's just so much agreeing. I think we think along such similar mindsets, and I think it's so wonderful. And I'm not trying to elevate myself to Cathie's status at all. I just think it's wonderful. And I also don't want to put myself in an echo chamber, so I'm looking for things to disagree with, right? But this is an interesting argument. The Archegos drama, which I covered as well, the big hedge fund multi-leveraging up, where essentially Archegos was able to take, William Huang was able to take somewhere around $2 to $3 billion and potentially extrapolate that 8 to 10x, which is ridiculous. And this is done by a process of rehypothecation, where you're basically taking your collateral and promising it to different companies to the point where no bank knows who actually gets a claim to that collateral, right? Big issue. Anyway, she mentions that the fallout that we saw from Archegos could have potentially led to a massive market disaster. The reason she believes there could have been a massive market disaster is because when other banks around the world saw this Archegos unfolding, this drama unfolding, a lot of other banks could have checked collateral. Hey, is this rehypothecated? What happens then if we want to claim this collateral? And what if all of a sudden banks start freezing liquidity lines or start dumping a bunch of stocks for other family funds like Archegos? And what if that sort of chain ripple effects throughout the economy? There could be a massive sell-off just from that. That could be a huge catalyst for de-risking. But she says that didn't happen. She said this was a battle test. And we're actually reassured because this didn't happen. Fascinating argument. I mean, it's true. Like that totally, every corporate compliance or lending risk management division went through their books that day after the sort of Archegos, block sale disaster. Yeah, so good point again. Then she talks about the rotation, this rotation to like financials actually being a good thing, banking going up. She believes when prices of things like value stocks that are highly indebted, not all value stocks, but stocks that are highly indebted and maybe aren't innovating, and banks that aren't innovating, she believes that when those prices go up, it's actually a good thing for her, the stocks she invests in, like Square, because she believes that it's just a matter of time before a company like Square disrupts a company like Chase, and then all of a sudden, if Chase is at a higher price, boom, here goes Square to the moon. Now, she obviously didn't mention this part about the price. I'm interjecting this, but if you have not yet, I encourage you to watch this if you're interested in knowing a little bit more about Chase versus the rest of the market, especially fintech. Watch the video that I did breaking down what Jamie Dimon just said at Chase. So just type that in YouTube, Meet Kevin, Jamie Dimon. It'll come up. You'll see his face on there. Really, really good breakdown of the massive 66-page letter JP Morgan put out. It summarizes it all for you. Then Cathie talks about how we might be in this era of a big transition where we go from late 1800s to early 1900s. All of a sudden we get cars, electricity, light bulbs. We get this massive explosion in growth from innovation. And so this is her belief. This is what she is investing heavily in. And she believes this disruption could be a lot bigger than what we've ever seen before, and that's why she's going so heavy on her innovative companies and her innovative picks. She mentions that Elon Musk responded to her on Twitter, her and her company on Twitter, asking about, well, what about the Buffett indicator? Why is it that market cap to GDP is as high as it's ever been? And she mentions this is simple. Now, this is where I'm actually going to disagree with Cathie a little bit. And I think you'll like my reason for disagreeing with this. So Cathie mentions that, look, here's the thing. When we calculate market cap to GDP, we put market cap up here to GDP. I'm going to use fake numbers here just to make an example. Let's say the market cap is $10 and GDP is $2. That gives you a market cap to GDP ratio of not $5, but it gives you 5, right? That's your market cap to GDP. When you increase GDP, what happens? Well, your market cap to GDP goes down. Instead of 5, it'd be like 3.3, right? So the more you increase GDP, the more your ratio goes down. And this makes sense. This is intuitive. Like in this case, you'd have a market cap to GDP ratio of 2. So what you want is GDP to be going up. The problem, and keep in mind what GDP is gross domestic product. It's the sum of everything that is produced in the United States. Now, some make the argument that this has to do with with internationalization, or I should say globalization. Gross domestic product is different from gross national product, which also includes what we're producing and selling overseas, which gross domestic product is just here. But the reason she gives for GDP to market, or market cap to GDP going down, is because she believes that innovation is deflationary. And when you have deflationary innovation, you're actually not going to increase the GDP, you're going to decrease it. So remember what we had earlier here, which was if we go 10 divided by 2, we get to 5. But if prices go down because of innovation, then all of a sudden market cap to GDP can go way out of whack. And she believes because we're going to see such deflationary forces in technology, she thinks GDP could actually go down due to deflation and lead this market cap to GDP ratio to go up substantially. Now, if we compare this to reality here, where we currently stand, we're probably more like this, 100 over 20, which would put us, 100 over, let's go with 5. There we go. This would put us somewhere around a Buffett indicator of somewhere around 20. That's roughly where we sit right now, is a Buffett indicator of around 20. And sometimes we see this go from 20 to this 25 range. Somewhere around there is where we're bouncing around. Cathie, and she admits she thinks this sounds crazy, but she actually believes that there's a possibility, she's not betting on this, but she believes there's a possibility that the GDP is going to decline potentially relative to market cap in this formula. Well, I guess she believes the conclusion is going to double. She believes that however it ends up happening, the mechanics of this, she believes this ratio, the Buffett indicator ratio, could double to 40 or 50, or basically the S&P 500, for example, could be selling for 40 to 50 times earnings in the future, mostly as more innovation gets priced in, but we actually see GDP lower because things cost less because of these deflationary forces. So her opinion is deflationary forces is why this market cap to GDP ratio is going up and why it's so relatively high. Now, this is where I'm going to disagree with her. So while what she says could be true, I don't believe that GDP is going to go down because of deflationary forces. I think we're going to find more things to entertain and pleasure ourselves with, toys, computers, travel. We'll have more stuff. We'll have eVTOLs, and we'll find more ways to spend more money on more stuff, right? In which case, I actually think GDP is going to grow. However, I do think that there is a short-term problem that we face. And when we look at what goes into market cap, right now what's driving a lot of market cap are high valuations at growth companies. The problem with growth companies is a lot of growth companies have low earnings today. So that means you put a high valuation into market cap for growth, but you're not seeing a massive increase in the GDP because these companies just aren't making a lot of money just yet. Like Tesla is going to make a lot more money when they're selling 10 million cars than when they're selling 1 million cars or 500,000 cars like last year. That's going to show up in GDP. But right now, Tesla's valuation shows up and not the dollar signs, right? Another thing to consider is another thing that goes into market cap are all the recovery stocks. Recovery stocks have blown up since November, right? So you got recovery stocks that have massive amounts of money going, or massive valuation increases since the election. That moves up market caps. But what's also not happening at recovery stocks yet? Revenues, folks, revenues. Even though we're starting to reopen, they're not making a lot of money yet, which means we're not seeing that reflected in GDP yet. So in my opinion, and this is where I differ from Cathie, why do we see a high Buffett indicator? It's because lots of companies are primed to make lots of money, either through reopening or innovation, but they're just not yet. Except the stock market is starting to price that in already, mostly because of recovery and innovation forces. So this is a place where I disagree, obviously, but and I'm not saying that her thinking is definitely wrong, but I do think GDP is going to trend up because people will spend more money on spending more. But I agree, there are going to be big deflationary forces. So it's kind of like a half disagreeal. Okay, so this kind of gives us a little bit of an overview of my opinion of what Cathie Wood here had to break down or what she had to say. Now, I want to give some bottom lines here. So some big bottom lines that I got from Cathie out of her latest talk here are, first of all, she thinks that bond yield spike could be temporary. I thought this was huge. Mostly because of that SLR selling off, if she's correct on that, which I think I have a suspicion she could be. I think that's a really good analogy. We've already before her video, we've talked about how we believe this corporate tax rate's going to stick at 25. Completely agree with her opinion on that. Surprised she didn't talk as much about supply chain disruptions and how that could be an issue for short-term inflation, why we might see that short-term inflation, but why it might not stay. She didn't spend a lot of time touching on that, just briefly touched it, moved on from there. Does believe that at some point the Fed is going to get forced into raising rates sooner than expected, but does believe we're seeing great signs in the economy for recovery, strength in the recovery, strength in the fact that we didn't have a disastrous fallout from the Archegos disaster we saw. And she's got some theories for why the Buffett indicator is as high as it is. She believes it's inflation. I believe it's low earnings. But both could be correct here in their own respects. So there you have it. These are my opinions on top of Cathie Wood, a summary on what Cathie Wood had to talk about. And folks, I appreciate you watching. If you like my insights and perspectives, consider checking out the programs linked down below on Building Your Wealth. You can use that coupon code down there. And folks, we'll see you in the next one.